How's it going, everybody? My name's Antonio. Thank you for stopping by. You're about to watch or listen to another one of the 2023 Outlook series episodes. This one specifically is going to be about geopolitics, monetary metals, because I am joined by Keith Weiner, who is the founder of Monetary Metals, funnily enough, which is a way for people to earn interest in physical gold. He's going to tell you more about that in a second. Who I'm not joined by, though, is your financial advisor. They're not present here today, and this would just be a conversation, okay? A conversation that's going to be broad and general and impersonal in nature, one that will not include any financial nor professional advice whatsoever, but it is probably going to include a lot of personal opinions, stuff like forward-looking statements and hopes for the future. So you shouldn't blindly trust anybody on the internet, and definitely not when they're speculating about the future of geopolitics, because it seems like nobody really knows what's happening. Do you, Keith? Do you know what's happening?
Absolutely. I have a complete book of how everything's going to go down, but unfortunately, I can't share it, otherwise I'd have to kill you. Just kidding.
Thank you for being here today, my sir.
Thanks for having me.
Yeah, pleasure is all mine. Pleasure is all mine. Let's take it sort of from somewhere like I like giving this metaphor that we get on a plane and we go 40,000 feet up in the air, and what would we see if we look at the world through your lens? I'm talking about stuff like terminal rates, inflation, QE, de-dollarization, geopolitics, banking crises, whatever it might be.
So maybe this is more like the 100,000 foot level, but we can go lower. I see the world as being kind of falling into the black hole of zero interest rates and beyond. So it's not about printing money to infinity and hyperinflation as a result of rising quantity of dollars, but rather the drowning of the interest rate going below zero. And every once in a while, the central planners get it into their head that they have to try to hike interest rates and try to somehow fight or reverse this trend. I think they kind of know this. I mean, first of all, anybody who can look at a chart can see that, yes, there's zigs and zags along the way, but anybody can see that it's been a falling trend since 1981. It was one hell of a mega trend. And one can debate whether or not those drivers are still in full force and effect, whether those drivers have ended. But the trend is there. And every once in a while, the central planners, as I call them, because that's what central banks are, they decide what they're going to do to us in the name of our own good, decide they're going to try to reverse this. And the last major time they tried to do this was, of course, 2005 to 2007. And we all know how that ended. And at root, it's a very simple thing. Every time the interest rate goes down, asset prices go up. So, if you look at the bond as kind of the quintessential asset in the monetary system, the bond price and the interest rate are a strict inverse. They're seesaw. That a lower interest rate equals a higher bond price, and that's just a strict mathematical relationship. But all other assets have a similar relationship, whether it's stocks, properties, you name it. As the interest rate goes down, asset prices go up, which means that all of those assets become worth more as collateral. And I use the word collateral now specifically in the context that you can pledge that collateral to borrow more. So you're getting a constant leveraging up, more and more debt being piled onto the same asset base, because of course the asset base is worth more. And everyone understands that central banks can't print wealth. I assume everybody understands that. But then when asset prices go up, they just take that as if that were real. And that's precisely the statement that when stated as such, they would disagree. But in practice, they sort of go with it. And so they lever up more because the asset is worth more in nominal terms anyways. And so the debt is going up, and the debt is being incurred in order to buy more assets, which means bidding up asset prices further. And so this is called a good economy, a healthy economy, strong economy. Everybody loves it. Who could possibly argue with a bull market, right? I mean, you'd practically have to be a communist to say there's something wrong with endless bull markets. And people have called me a communist, which is kind of ironic. I'm the most hardcore radical for laissez-faire capitalism that exists, and they call me a communist because they don't get what I'm saying. But you get this very unnatural central bank stimulated, rising asset prices. And that's wonderful fun on the way up. Everybody feels they're getting richer and richer and richer. If you read the Austrian school, you know that this is a false boom. It's not actually a healthy economy. The boom inevitably must turn to bust if there's going to be an end to the credit expansion. And so the central banks, for whatever reasons, either to prove their own credibility, they want to prove that they're not just, they are real guard dogs and not just pussycats, or because they're in the throes of the quantity theory of money and they see consumer prices picking up for whatever reasons, which could be non-monetary in nature. They think, okay, we have to fight that. And the conventional thought on how you fight that is jack interest rates up, which will decrease the quantity of money, and so on. But for whatever reason, they decide, okay, we're going to fight this, and we're going to raise interest rates. When you get a variety of, creatures from the dark, like, if you take a submarine down to the bottom of one of the lowest trenches in the ocean, you find these blind creatures down there with tentacles or even self-lit. There's a fish that has a little light bulb kind of thing on a stalk on its forehead. All this, sort of creepy, things come out like yield curve inversion, and then eventually you get to bank runs. So, which now, we're having that problem in the US for 3 weeks now. It's probably started in its early phases in Europe as well. Credit Suisse, of course, was forcibly taken over by UBS. The Swiss government put that deal together. And what's going on? Well, when interest rates are falling, the banks are getting increased deposits. And what do? They go and buy long-term bonds with those deposits. And then when interest rates are going up, the value of those bonds falls. And at the same time, they're getting outflows. They have to sell those bonds that have fallen in value. And so they have a shortfall that they're actually not obliged, at least in the US. After 2009, there were some voices, including some in the sound money community. Steve Forbes, whom I consider a friend, wrote very vocally about mark-to-market as one of the, if not cause of the 2008 crisis, at least something that was exacerbating it, and argued, at length that we should repeal mark-to-market regulation. And so in 2009, the Financial Accounting Standards Board in the US, and I don't know if the international folks followed or not, said, okay, you don't have to mark-to-market. If you have a bond and you put it in the hold to maturity category, then you can just keep it. You still there? Oh, there you go. You have this bond that's worth less than par, but you're holding it on your books at par, and it doesn't matter until it matters. You start getting withdrawals because the central banks are decreasing the amount of cash in the system and has to go away. And the banks are forced to sell these things, which they're pretending are worth 100 cents on the dollar or 100 euros on the, or 100 cents on the euro, but they're not. And so if you bought, I did a little research into this, if you were a bank and you bought a 10-year treasury bond in August of 2020, when the interest rate was 0.57%, and you sold it the day before, or a couple of days before, the beginning of the week when Silicon Valley Bank collapsed, you sold it for 80 cents. So, there's a 20% loss on it. So the banks are taking these big losses, finding that they have inadequate capital. And why is the capital inadequate? Because all asset prices are falling when interest rates are rising. So the central banks think they have to raise interest rates, but regardless of whether or not that may or may not cure consumer price inflation, it's certainly going to cure the banks in the sense of putting them in a smoker at 200 degrees and cooking them, which is what's going on right now. I don't know if that's 100,000 feet or 40,000 feet, but there you have it.
I don't even know do planes go 100,000? They don't, right? Nothing goes 100,000 feet.
I think some of the military spy planes might, the U-2 or what is it, the SR-71 Blackbird, I think they're reputed to go to those kinds of heights.
Probably a bunch of planes we don't even know about that maybe even go that higher.
Right.
Yeah.
But not your Airbus 300, no.
True. Well, this is better than I was having a conversation with somebody at the beginning of the year, and I even thought that helicopter. This is me, European, being on the normal metric system. Just to make a point here, I thought helicopters go 30,000 foot in the air, but they don't. Apparently, just some of them go like rescue helicopters and whatnot. But to go back to the point, though, like there's a lot to unpack there. But at the same time, I was talking to somebody about macro, and it gets so deep, it gets so complicated. There's lots to talk about. There's lots of content to create about. And then he sort of closed off the conversation by saying, it doesn't even matter all that much. You shouldn't put that much brain power into it, because in the end, they're just going to go back to QE. They're going to print more money, and your stocks are eventually going to go up. What do you say to that argument? Is that too simplistic?
I think in the case that I've just made is that they have to. Now, I'm kind of a fan of that saying, history doesn't repeat, but it rhymes. And in this context, I'll say they won't call it QE. I think QE now has a bad reputation. So they'll call it something else. So they now have the bank term lending program, lending facility, I forget what they call it. This is somewhat controversial. Some people are saying it's not QE. Some people are saying it is QE. But the Fed has said to the banks, and I don't know what the ECB probably will do something similar, because all the central banks, talk to each other. The Fed has said to the banks, okay, you have this problem in that these bonds that you bought back in, let's say, 2020 are now very underwater, but you have these redemptions you have to pay. So we will, instead of forcing you to sell it at lower prices today, which then forces you to realize losses and mark your books to the point of insolvency, because they have very thin capital cushions. Instead, you can borrow from us, and we'll take those bonds as collateral, which is a standard repo, purchase-repurchase agreement. Although I have not seen the word repo used for this, this is basically repo. The difference is the Fed is claiming this is full recourse. That is, that the bank owes the money. It's not just a matter of here's the collateral and I'm done. The bank actually owes the Fed the difference. I don't think the Fed's in a position to demand that. And if they were, they wouldn't need this program in the first place. This is a solvency problem now, not just merely a liquidity problem. So we'll take those bonds as collateral, but we'll take them at par value. So if you bought it 100 cents on the dollar in August of 2020, it's only worth 80 cents today. We'll take it off your hands at 100 cents. Now we're going to call it lending, and we're going to say it's, full recourse lending and all that. But you can, wave your hands and say abracadabra all you want. The reality is the Fed just, in effect, bought that bond. And not only did they buy the bond from the bank, which is, QE to use another term, but they bought it at much higher prices than prevail in the market today, which is sort of a even, more virulent strain of QE. It's not just QE, but it's QE on steroids. They say it's only 1 year term. We'll see about that. It has to be, in my theory, it has to be at least as long as it takes for the market price of those bonds to recover. Once the interest rate, resumes its falling trend and interest rates get back to, where the banks bought those things, then the Fed can close the program. Whether that's a year or not remains to be seen. And they say it's full recourse, but the Fed's in no position. That would just take the banking system down. I mean, why would you prop it up only to just go kick the prop out from underneath it right after? So, yes, they absolutely are going to have to go back to the old regime. There are two things that have to happen for the world as we know it to continue going on. One is interest rates have to continue to fall. It's not a matter of low interest rates as such. It's falling as a dynamic. It has to always be going to lower and lower rates. And number two is the total debt in the system, and debt in various places in the system must continue to grow at an exponential rate. Otherwise, if either of those conditions aren't true, then the marginal debtors default. They're squeezed. And so there's been a lot of squeeze going on, even before the Fed was hiking very far, squeeze going on in the rest of the world, as there's a dollar shortage. And so then the Fed has swap lines, and all of these things So in a way, it's almost a game where they don't want to say it's QE. So the Fed pretends to taketh with one hand while they giveth with the other, but the other is under the table. So they're saying quantitative tightening, higher interest rates, but we're going to buy those bonds off of you at an effective interest rate of 0.57%. So there's it's like QE plus subterfuge plus an extra supercharged, dose all in one.
I understand the second thing that you said, that two things have to happen. So debt has to grow, because that's how the system works, right? You take debt with interest. The only way you pay it back if there's more debt to service your capital plus your interest. What about if you inflate that debt away? That's something that's always talked about. What if the dollar dies? There's no,
Well, that's kind of like, suppose you have cancer and we're talking about cures, and somebody says, well, what if you die? Then the cancer, then the cancer goes away. Well, okay, sure, but is that really a good cure? So as far as inflation, most people think that the value of a currency is 1 over n, where n is the number of currency units. That's obviously false, right? So the dollar has a far greater number of currency units than probably all the other currencies combined. If it were really true that its value is 1 over n, the dollar would be the least valuable currency, which it certainly is not. And then they take it as a corollary that the value, that the prices go up as a inverse function of the number of units, and the value of the dollar is 1 over prices. So if prices double, they say, then the dollar is worth half. And they get into this whole idea of nominal versus real rates, which sends me into, I always have to go into a little rant. The actual rate at which actual lenders actually lend actual dollars to actual borrowers is dismissed as nominal. But meanwhile, we make a hypothetical calculation that from this nominal rate, we subtract inflation, which even the proponents of this can't agree as to how to define it or what consumer prices to include in the bucket. But we subtract this rather hypothetical value from the nominal rate, and we get to the real rate. So prices can double for a lot of reasons. In Europe, you have quite extensive green energy restrictions. Germany shutting down nuclear plants, bans on not only coal and oil, but now hydrofracking, carbon, all these things. That could cause prices to double and double again. That does not help debtors get out of debt. It makes it worse, because what they need is revenues. And not just revenues, but profitable revenues. And the fact that consumer prices double due to such things as green energy restrictions does not help them increase their profits. But from a monetary perspective, inflation is the process of borrowing more. I'll say that again. Inflation is when you're borrowing more. Sure, it may be the case that each of the dollars you owe is worth less, but you owe exponentially more of them. You can never get out of debt by borrowing more. That should be an axiom. That should be the first thing that's any professor of econ writes on the blackboard. You cannot get out of debt by inflation, because inflation is the process of borrowing more. That's how our system works today. And so people have been saying that, of course, for many decades. The debt problem is worse today than it was decades ago, even though the dollar is worth less than it was decades ago, or the euro or any other currency. They are falling in value, that's true. But that doesn't help the debtors.
So we can keep lending into eternity?
Well, there's a problem when you look at, if it's just a matter of increasing quantity and increasing prices, then in theory that could go on forever. I mean, we've had inflation for well over 100 years, and basically paper currencies, various forms in Europe basically was done with the gold standard on the eve of World War I. The U.S. enacted the Fed, although we still clung to a much adulterated gold standard after 1913, and the U.S. wasn't really done until arguably 1933. But call it 100 years of increasing quantity of paper currency and increasing prices. Well, if it went on for 100 years, why not another 100 or another 1,000? And the only real damage is nostalgia. Hey, do you remember when we were kids, gasoline was only 39 cents a gallon? Oh, I remember those signs. But who cares? I mean, salaries are much higher too nowadays than they were in those days. But the argument I'm making is that, debt is going up. Well, there's a limit to debt capacity. And then debt is going up because interest is going down. And the interest is giving an artificial signal of of the economy and value of collateral and all these sorts of things. But the other thing I said is interest is going down. Interest necessarily must be going down, or the whole system fails. Well, what happens when you get to zero and beyond? And Europe basically did before this latest purge, where they decided to hike interest rates. The interest rate was quite negative in Switzerland, but you also had negative interest rates in Germany, Netherlands. I'm not sure about Belgium, definitely Netherlands and some of the Scandinavian countries. The UK had negative interest rates on some of their bonds, Japan, etc. What does negative mean? Now, I just want to reduce this to something really, really simple. In any normal world, if you have an enterprise that is destroying capital, destroying wealth, destroying value, it should go out of business, and the sooner the better. And whatever capital is left, and of course, whatever talented people that are working there, should be reallocated to other firms that are somehow creating value rather than destroying it. But what happens to a firm if, let's say, the firm is destroying its capital at 1% per year, but it can borrow capital at negative 2% per year?
It's still negative.
It can mark it as a profit.
But it's technically still negative. Yeah, two minuses are a plus, but it's technically still negative, right?
But it has a net interest income from its borrowings. And when you add that in, the net is positive. And if something's positive, you want to scale it up and do more of it. So I talk a lot about incentives and how a falling interest rate changes incentives in certain ways. Obviously, it's a disincentive to save, and it's an incentive to borrow. But a negative interest rate, it's just a naked incentive to destroy value, to subsidize. It's feeding the capital of the investors and the savers to wealth-destroying enterprises and sending a signal and an incentive to wealth-destroying entrepreneurs to increase the scale of their activity. So this is not something that can go on forever, because capital is finite and very precious. And if you're destroying it in that way, it could take a long time. Adam Smith said there's a great deal of ruin in a nation, but it has a finite terminus. It cannot go on forever.
Well, I'm surprised that you, as communist, are not quoting Karl Marx and Adam Smith, but it makes sense. Jokes aside, though, how does that lead you to gold, though? Because the thesis, I guess, is that negative real interest rates should push you into gold, which does not yield anything, but you have negative real interest rates, so that's a safe haven, something.
Yeah, so I'm talking about gold as a money. I'm talking about the economics, the monetary economics of gold versus the dollar. I'm not necessarily saying buy gold because it's going to go up.
Oh, that's what you meant with the tweet today. You put out a tweet today that said gold will take off when investors figure this out. And you said something about two things in there being wrong. And then I assume investors was one of them, because gold is not to be invested in. And taking off, gold has its own price, because one ounce of gold is always 1 ounce. Is that something among the lines of what you meant?
Actually, you're very good. There's actually three errors in there, and you got one that I wasn't thinking of, which is gold's not an investment, gold's money. And money is the thing you hold when you don't care to invest or choose to invest. When you want to get out of all your investments, what is it you hold? And that's gold. So that was a headline on an email letter that I received today. Gold's going to take off when investors figure this out. And number one is gold doesn't go anywhere. It's like saying the lighthouse is going to take off when the people on the ship figure this out. Well, it's the ship that's sinking. The lighthouse isn't going up. It's the ship that's going down. And then number two, it's this ever popular idea that, whether it's the dollar going to go to zero, gold's going to go to infinity, that basically there's this one little secret that they don't want. Usually there's a they, a shadowy cabal of they, who's actively wanting you not to know. And once the secret is out, it's like one of those movies where, that action hero is running and diving and rolling down stairs and shooting people left and right because there's some little tape with some magic secret on it. And if that magic secret got out, then the world as we know it would be altered forever. It would be World War III, or everybody would dump their dollars or something like that.
Yeah.
There's no such magic secret. I mean, the unsoundness of the dollar is out there for everybody to see, and it's been that way for many decades. I have spilled, trillions of electrons, probably 10 to the 50 electrons, writing about this. And it's not a magic secret that props up the dollar or that keeps gold down or whatever. There's no, hey, you have to read this article and you'll understand why. When they discover it, then this is going to happen. So if that's your investment thesis, I said, then you're investing on the wrong basis. I do think for other reasons that the price of gold is likely to be going higher. And one of the things I would point to, we were talking before you started recording about, there's been these corrections in gold, it goes up, and then there's some selling, Ukraine war, the price of gold went up. I think that was pretty logical because at the time the war started, nobody knew whether that was going to be some, World War III that was going to put the world in flames. And if that was the case, I guarantee you the price of gold, there are very few guarantees in this world. I guarantee you if there were nuclear bombs dropping all around the world, the price of gold would be a hell of a lot higher than it is now. And not that anybody should wish for that. But it was pretty clear, I guess, after the first few weeks that, regardless of what may happen there, Russia is kind of bogged down. And this isn't going to be some giant, fast-moving nuclear conflagration. This is going to be, rocket launchers and grenades and machine guns and all that stuff. But now, in the wake of the banking crisis, that's, I guess I'll say, incipient banking crisis, the one that's just getting underway, and that's going to force the hand of the authorities to throw the rule of law out the window, as they did in the case of Credit Suisse, right? So they said in case of Credit Suisse, the stockholders will get something, the bondholders will be wiped out. So there goes, 600 years of law, thrown out the window and under the bus. In the case of Silicon Valley Bank, in the US, it's very well established. We have deposit insurance from the FDIC. All deposits up to $250,000 are covered. Every penny above that is not covered. Well, that was what they initially said on the Friday when they seized the bank. But by Sunday, they said, oh, well, we just got another bank, which was Signature Bank in New York. And by the way, depositors will be covered beyond the 200, no limit on the deposit insurance. So they're just, throwing the rule of law out the window here. I just lost my train of thought. There was a point I was going to make about the response of the policymakers. And as people see what's going on, they logically turn to gold, not necessarily as a speculation, but as an escape hatch. And I love to use the analogy right after the Cyprus banking system collapsed and there was a crisis in Cyprus. I called up and I interviewed a gold bullion dealer in Nicosia, Cyprus. And I said, first of all, I said, did you warn everybody? And he said, absolutely, but they wouldn't listen. And, we're talking about it. And it was very clear to me that if you had bought gold in Cyprus a couple of days or a couple of weeks before the banking crisis, the virtue wasn't that the price of gold went up in euro terms. If you look back at that historical moment, actually it didn't. I think the price was sideways to down. But the point was, if you had gold in your pocket rather than a Cyprus banking system deposit, and when the banking system collapsed, I think you had like 40% unemployment there. It was horrific. If you had gold, you could have just gone down to the harbor, gotten on a boat, paid for your passage in gold, gotten to the mainland where there were jobs, and you could have continued your life normally. If you didn't, if you were stuck in the banking system, you were just, waiting for the authorities to tell you could have your money, which then they said a couple of weeks later, they said, we're going to reopen the banks. You can have 600 euro per day. That's it. So the point of gold is that it saves you the exposure that you don't want in these situations. And so I think there's a long-term trend of people coming to gold for the first time, as they did in 2008, as they did in 2020. And it's a ratchet. Once somebody comes to gold and discovers this, they don't forget and go back to sleep. Then, okay, they buy a certain amount of gold, they park it away in their sock drawer or whatever it is. But I don't think they generally abandon it. If they buy it for that reason, they don't generally abandon it. If they buy it because they think the price is about to burst to $20,000, then they sell it when the price doesn't, in fact, goes to $20,000.
Right. As a speculation instead of using it as money. And you make a good point there with Cyprus. I have a story of my own that I've probably told to death by now, but I was born in the 90s in Bulgaria, and I grew up in Bulgaria in the 90s, which means post-communist era. And this is why I sort of grew up on stories and seeing the post-communist Bulgaria, which was destroyed, and that's why today I am wholeheartedly against communism. But that's not the point. The point is that in 1997, our currency collapsed. It was revalued overnight, pretty much, and I was promised to get a bicycle, I believe. I don't have the exact memories because I was 2 or 3 at the time, but when my mom got there, when my mom got to the bank to withdraw her money, what she could withdraw wouldn't even pay for the packaging on the bicycle. And my family basically got into hot waters then, because they couldn't pay rent that month because money was in the bank. Something happened. So what they started doing is they started selling whatever gold jewelry they had left. So that's the story my mom and dad, they tell it to this day, how they sold their wedding rings that were gold. They sold some necklaces, earrings, whatever it might have been in gold. That's how they managed to pay rent for a couple of months until they sort of got back on their feet after the currency was revalued. And this is happening in Europe. This is not some imaginary land or a third world country. Well, I guess it was a second world country back then, but kind of still is. But it was happening in Europe, okay, and it's Cyprus as well. This is very close to home, and it seems like not many people believe that it's possible, though. So, I mean, you can comment on that.
Yeah, what can I say? I mean, Americans understand gold the least. I think I'm in a position to say that as an American. I can pick on my own, but also as somebody who's traveled and met and I haven't been to Bulgaria yet, but we have a client there now, so I'm sure I'll be there at some point soon. And in most of the world, hyperinflation is within living memory, if not in that country, in a neighboring country. And not just, Weimar in the 1920s, which isn't really living memory anymore, but Austria in the 1956, Bulgaria in 1997. The US has never had a currency crisis. We had the late 1970s, which I'm just old enough to remember. I was 12 years old in 1979. And, the official inflation rate, I think, was 12 or 13 or 15%. A lot of people would argue it was higher, but most of the world, you say to people we had inflation at 15% per year, they'd say that's cute. Tell me about a real crisis. And these things happen, and they happen without the mainstream really understanding, without being able to predict it, and without even being able to explain it after the fact. And that's why people hold gold. That's one of the reasons. I mean, there's several, but and that's why they should own gold. You should have some, and it's your, personal, safety, margin. Somebody who studied under Fekete at the same time that I was there tells a story. So he was Hungarian, and they were fleeing in 1956, one step ahead of the Soviet tanks. And so he was at that time, I think, 12 or something like that. And they got to the border with Austria, but there was Hungarian guard station there, and the Hungarian guards came out. And, they could have gotten arrested or worse. But the father took off, my friend's father took off his gold watch and handed it to the commander of the guards. And the commander of the guards looked at it. He could tell that it was real gold. And gold is very heavy, among other things. And said, "Okay, my men are gonna be on patrol this way and come back in 15 minutes. You better leave because if you're still here in 15 minutes, we'll kill you. But they gave him 15 minutes to run for the border with Austria and get to Vienna. And from Vienna, they got to somewhere else, and somewhere else they got to Canada, and then they set up a business in Canada. And my friend to this day has this business. I guess he's retired now, but that business lasted for many decades. And so gold has always served that function, and everybody should have some of it.
But some of it. So that's sort of the part where I'm still thinking about, and also how do you store it? Because all of these stories that you would hear, the gold is stored in some practical thing like a watch, a ring, earring, something that another person might want, because it is not only it's gold, but it has some sort of an added value to it because it is jewelry, or it has some other purpose to it. So, I mean, if you're storing gold in bars and you have like a kilo of gold, which is like 50,000 euro, or give or take right now, you don't want to pay for a taxi ride with a kilogram of gold, but that's the only thing you have. You cannot chop it down either. So how do you how do you put it in your portfolio?
Yeah, so obviously today there are a number of companies that offer gold accounts, and then you can tie it to debit cards and connect to the payment rails for the mainstream system. Monetary Metals, my own company, we're not about using gold to make payments, but we're about you say putting it in your portfolio. We're about paying a return on it. So instead of paying to store it, right? So if you have it in a professional depository, you're going to pay for storage. Typically, people pay 0.75% per year. So if the gold price is going up to 20% per year, nobody cares about that. If the gold price is going sideways, that kind of gets old. But we pay interest on it, and we pay 2 to 3, in some cases 4% interest, and no storage fees. So you can have a professional institution holding it for you and doing a variety of things, for you. But I do think everybody should have a little bit of gold, like physically, let's say in the form of little coins or bars, And I always use the line in your sock drawer. Like even if you're in a small apartment and you can't open the walls because your landlord would not allow that, you can always put a little bit. I mean, a couple, 3, 5, maybe 10 ounces. Put it, hide it someplace around, and it's accessible to you personally. It's not in some professional vault that you couldn't get to in a crisis. But you wouldn't want more than that personally, because you're at risk of fire, flood, home invasion, all those sorts of things. And then to have a greater exposure to gold, depending on how much net worth you have, to have a greater exposure to gold, you want to do that in a professional way. And there's obviously, I believe in monetary metals. I think people should get interest on it, but I'm not here to necessarily promote what we do, but you should have it professionally looked after.
That makes sense. Depending on your net worth, the more it goes. But I guess the first step would be to make sure that you have some sort of on hand, as you said, in your sock drawer, and then as your net worth grows, and then you grow that percentage, maybe something like that, right?
Yeah, you wouldn't keep $1 million or €1 million of gold at home. That's crazy. Or even 100,000. That's nuts.
Yeah.
I mean, I know people who do it. I also know somebody who woke up at 3 a.m. with a guy in a black ski mask shoving a gun in his face and said, "I know you have gold at home. Now open your safe, or I'm going to blow your brains out."
Sure, but you do get to show it off on Twitter, though, which is also cool. So, jokes aside, I like seeing those pictures. It's cool. I like seeing people's stacks. I mean, everybody's got their own thing. I want to go back to talking about the currency crisis, because you said the U.S. has not had a currency crisis, and you sort of alluded to it. They haven't had a currency crisis yet. Are they about to? I know you don't believe in the de-dollarization narrative, so are they about to have a currency crisis?
I do not believe we're about to have one. Is coming in the end, but I think the U.S. dollar, it comes last. And not for the reasons that most people assume. Oh yeah, America has a bigger military, bigger economy, whatever. All those things are true, but at the end of the day, all the other currencies are dollar derivatives, and a derivative cannot survive the collapse of the underlying. It'll always be the other way around. Before Google shares collapse, it'll be call options on Google that collapse,
Right.
or it'll be call options on an ETF that, I don't know if you have unit trusts or something like that for European, stockbroker accounts to be able to hold Google shares. But if you had a unit trust in Europe and then you had call options on that unit trust, that's what would fail first. Google would be the actual underlying shares would be the last thing in that chain that would fail. But yeah, eventually, because the dollar is credit. And what happens when you abuse your credit? Well, if you really start out with great credit and lots of it, it can take a long time of dissipation and abuse and cheating, but eventually you get to the end. I don't think we're there yet. I think very perversely, the dollar is going to go up against has been going up against all the other currencies with corrections along the way, but the peoples of the rest of the world are going to be putting their capital into the dollar and bolstering it for quite some time to come.
Even if the Fed stops hiking or starts doing smaller hikes, but the ECB continues to hike, wouldn't that mean that the dollar index would weaken?
I mean, if you have an interest rate differential where the euro is paying, I'm not sure the euro would pay higher, but let's say the euro would pay higher, that makes it relatively more attractive. But there's so many reasons why people want to bail out of the euro that I don't, even that I wouldn't see ending the trend. And in any case, I don't think the ECB is in any position to hold interest rates higher than the Fed is, and for the same reasons. Interest rates have been zero or negative in Europe for a long, long time. The leverage that's built up is such that you can't reverse that without just destroying all the financial intermediaries.
True. What do you think? You say eventually, if you want to talk to me about, if you want to pull up your crystal globe and talk to me about when the dollar is going to die, I'd appreciate that. But if you can also talk to me about what event's going to make that happen, because let me tell you why I'm asking this, because you can also maybe talk to that, is because I'm looking at what's happening with oil in Saudi Arabia. I'm looking Saudi Arabia and China. Kenya is now going to be buying oil in shillings, I guess it is. Stuff like that. The BRICS countries are across all news headlines. So what is going to make the dollar, die, basically?
So I wrote an article about, I think it was called Oil, the Ruble, and Gold Walk into a Bar. Something like that was the title of the article. I was talking about this idea that people are going to pay for Russian oil in rubles. Okay, right? And that's what Russia demanded. And I guess you have to play the game. The currencies are all exchangeable, in a millisecond. So, if the seller says, I want you to give me this currency, then the buyer is going to hold what the question is, what currency do people choose to hold on their balance sheet? And then even if the millisecond before a transaction, they're obliged to sell that currency and buy the currency that the buyer demands, what currency do they choose to hold? And so I proposed a little example, a little story. Suppose you hire some kid in your neighborhood, 8-year-old kid, to mow your lawn. The homeowners association is getting after you. The lawn is getting tall and scraggly, and this kid comes by and says, "I'll mow your lawn." And you say, "How much, kid?" And he says, "I want 8 ice cream sandwiches." I don't know if you have ice cream sandwiches in Europe, but it's kind of this soggy chocolate cookie. It's rectangular, and inside is vanilla ice cream. So, you Google that on your phone and you find out that 8 ice cream sandwiches is about $10, which is about what you'd pay the kid anyway to mow the lawn. And you say, okay, and you realize what's going on is, kid's a little chubby. His parents are not willing to buy him ice cream sandwiches. So even if he has the money, he can't get what he really wants with it because his parents won't let him buy that. But if you give him the ice cream sandwiches directly, then it's outside. He's bypassing sort of the parental controls of his parents. So you go to the store and you buy a box of ice cream sandwiches and hand it to the kid. Is ice cream sandwiches de-dollarizing the neighborhood? Not in the slightest. He just can't buy them directly, so he says, "This is what I want you to do for me," and you figure that it's basically equivalent. 8 ice cream sandwiches, $10 at the same economic value. but your economic calculations in dollars is not ice cream sandwiches. You don't think this is an 8 ice cream sandwich lawn. You think this is a $10 lawn. And so the economic calculation doesn't change. The real underlying, medium doesn't change. You're just doing a favor for that kid. And so, all these different countries may do these trades in whatever currencies. But the question is, does anybody really want to be a creditor to Putin? Does anybody want to lend to Putin? Does anybody want to lend to Xi in China? Now, I can speak a little bit to that, having visited there. Everybody who has any degree of wealth is constantly risking his life to dump the yuan and buy dollars outside of the country. So the people in China, if they unlock them, so they have capital controls, it's illegal to do this. And since the people are evading the capital controls, they keep ratcheting them up, both the punishments of what they'll do if they catch you, and they keep closing all the loopholes that keep being discovered by the people. And this has been an arms race that's been going on for decades there. The Chinese government fears that if they were to drop the capital controls, that the currency would be sold off by the people, would collapse. So even the Chinese people don't want to be creditors to Xi. Then you get to Modi in India. Does anybody want to be his creditor? Lula, the socialist who just took over in Brazil, anybody want to be his creditor? I don't think there's any demand to hold these currencies as a balance sheet holding, other than, okay, you dump your dollars to buy those currencies in order to send them to pay for whatever commodity that these countries are exporting. And that's it. So I don't see that trend, really changing. I don't see any of the drivers for it, being there. And I think this is a very old, rumor that keeps cropping up every once in a while, particularly in gold spheres. And you can see why. Because the dollar was about to be dumped and the price of gold in dollar terms is much higher. Buy gold now, it's about to go up. It's all very self-serving.
I guess, though, sort of a counter argument might be a commodity-backed currency, right? Because if the guys at the BRICS countries don't trust each other, why wouldn't they put some type of fail switch in between gold, oil-backed currency, whatever it might be, because they have plenty of it, and make it work that way?
So I have to put my monetary economics hat on here for a minute and get all professory. And I have to say, what does backing mean in a currency? And it can mean, one of three things. It can mean redeemable. That is, I take my banknote, pretend this is my banknote, it's my business card, but I take my banknote and I go to the teller at the bank and I get back a gold coin. But that obviously doesn't work if you're talking oil, because, you mentioned a kilo of gold earlier. Kilo of gold worth of oil is what is it, almost 1,000 barrels? That's like a small swimming pool full of oil. And it's smelly and it's toxic. It's also highly flammable. It's volatile. It degrades when it's exposed to oxygen and sunlight. It's highly regulated. So you couldn't very well redeem that amount of currency that's worth a kilo worth of gold, but in oil. So the other two, so if it's some other currency, some other commodity other than gold backing the currency, it doesn't mean redeemable. Nobody's in a position to redeem. It means that either trust us, we have that amount of a commodity set aside in a warehouse, and our currency is backed at this ratio. And if that trust us, we would never have less than this commodity in our warehouse. That I just don't think has any credibility. I'm not sure it ever did, even 100 years ago, but today it would have zero. And then the third one is, okay, we're going to somehow manipulate our currency in the foreign exchange markets such that we will hold the value of our currency to trade at this ratio against this commodity. And the problem is, until they decide one day that that ratio is no longer convenient or no longer holdable, and then they declare the new exchange ratio, it has no teeth and no credibility. Redeemable is the only thing that makes any sense. And if you want it to be redeemable, then gold or maybe arguably silver are the only metals that the only commodities that make any sense for backing currency.
How do you, I mean, if that's not why central banks are buying gold, because it's being speculated that's the reason why like China has increased their gold holdings. Russia just reported last week, I believe, that they bought what 1 million ounces of gold. Not doesn't sound like a lot of money when you convert it, but on a country level, it's also not nothing. There's the fifth largest holder, I guess. Why are central banks buying gold if they're not really planning on doing anything with it?
Well, maybe planning on doing something with it, but the first thing that needs to be said, gold is the money, it's the monetary system of free market.
Mm-hmm.
If you want to run an authoritarian regime where you just order people to do what you want, and if they don't do what you want, you just disappear them, then you have no need for gold. And all the countries of the world have been moving authoritarian for at least the past 100 years or so. There was quite a golden age that ended when war broke out in 1914, and since then the trend of socialism and fascism has been on the rise. They don't want gold, and their monetary planners attend Western universities to get the same Keynesian indoctrination that everybody else does. I think that's the first thing that needs to be said. Why are they buying gold? They want something that goes up, or at least holds its value, but probably goes up in terms of their local currency. If you're the central bank of Russia, your books are, of course, denominated in rubles. So if you buy something that goes up in ruble terms, you can, try to stabilize the value of your ruble, or if not, at least you have something to sell. So they're looking for something that has a gain. They're not really thinking of it as okay, well, we'll have an actual gold redeemable ruble, which would be unthinkable for a Keynesian, let alone an authoritarian regime like that.
Mm-hmm. So just the petrodollar is not going to turn into the petro-yuan, or the petro-gold dollar breaks something.
Well, our other currency is going to be used, at the moment of exchange. Would you call it the ice cream dollar in the case of the kid mowing your lawn?
Mm-hmm.
Yeah, it's used as in exchange. Particularly now, the thing that needs to be said here when we're talking about Russia is that whatever one may think of the rightness or wrongness of Russia invading Ukraine, and I certainly have Ukrainian friends. We had a Ukrainian contractor working for us for a while. Whatever you may think of the rightness or wrongness of that, everybody, including Putin, knew that if he did that, the U.S. and its allies, it's not just the U.S., would impose sanctions against Russia, and they seized every Russian asset that they can get their hands on, and that included boats, planes, properties, and of course, cash and treasury bonds.
Mm.
It's not a weaponization of the dollar per se. It was Europe and the U.S. and other countries mocking Russia out of many of the systems that the modern world operate on. So now Russia is finding itself, okay, how do we do transactions? We need to keep the flow of hard currency, coming. How do we do those transactions when we're locked out of the SWIFT system? Okay, well, we'll do our trade in rubles. We'll do this. We'll do that. They can use gold for that purpose. And if anything, there's an argument for the remonetization of gold, that when countries don't trust each other, they're not necessarily openly hostile. They're not necessarily at war, but they don't trust each other, and they don't trust anyone else either. What form of money do they trust? Well, gold doesn't demand any trust. It's cash on the barrelhead. Do you have the 1,000, metric tons of wheat that we ordered? And Russia says, here it is. And Russia says, do you have the 1,000 ounces of gold or whatever? And you say, here's the gold. And it's a cash on the barrelhead kind of exchange. But I don't see that changing anybody's balance sheet, which is really what the world's reserve currency is about.
I'm trying to look at something. I saw a video from Peter Schiff recently. It said, there it is. The US dollar will join the Zimbabwe dollar in the graveyard of dead fiat currencies. And you're sort of saying it's gonna, but eventually, and not today. And it almost seems to me like that whole narrative is uninvestable for someone like me who is primarily looking to grow their capital right now. Is that true?
Yeah, I mean, I remember he predicted in July of '09 at Freedom Fest that there would be hyperinflation in the dollar by the end of the year. So 14 years ago. 14 years is a significant component of somebody's investment career. And we're only on this earth so long, 14 years. What percentage of your adult lifespan is that? I don't think I certainly don't think that's a trading thesis today anyways. Again, it's a reason to hold some gold, but not as a trade, just as a, if you want to call it hedge or insurance or protect yourself, or monetary reservation demand. But no, I don't think the dollar is going to join Zimbabwe this year or next year or the year after. Earlier you said, when do you think it's going to happen? And first I was going to joke and I was going to quote Yogi Berra, the pseudo-philosopher, who said predictions about the future are hard. Predictions are hard, especially about the future. And then I was going to say, in around 2012, I was relatively new to all this, and I thought that the dollar had 5 to 7 years left in it. And I'll admit that and say, okay, that's what I said at that time. And obviously, here we are, well beyond 2019, and life continues to go on for the dollar. And I think it has, years certainly left in it, maybe a decade, maybe 2 decades. These things are very, very hard to predict, because what you're really talking about is when the capital is consumed. And there's a lot of capital. This was a very, very rich civilization. And America was the richest place in that rich civilization. And now it's slowly being consumed at an accelerating rate. But there's a lot to consume. And there's a lot of incentives not to consume that the Fed has to overcome with its perverse incentives of falling interest rates. It takes time. So I think the people in the rest of the world will be putting their capital into the dollar because their own currencies are worse. And that will stave off the collapse of the dollar even longer.
So what is the trade? That's my favorite question when somebody publishes like a super long research and then the first comment on there is, what's the trade? What is the trade?
It's very hard to go from, here's a macroeconomic view, or not a macroeconomic view. Here's a theory of how the world is put together. It's hard to go from that to what's the trade that's going to make you money, i.e. dollars, in the next 30 days. And anything outside the 30-day window, people are going to say, Keith, you're just wrong. Shut up, you idiot. I think the price of gold is, in a bull market. That doesn't necessarily mean that it's going to rise in 30 days, but I think gold makes a decent trade right now because of all these trends that, I touched on a few of them, but I think new people are coming to gold for the first time because of the banking system crisis is one thing. It's interesting that gold is unloved, almost almost a taboo topic in mainstream, financial media. And here we are, almost at an all-time high in dollars and at or beyond all-time highs in most of the other currencies. That's a very interesting phenomenon. It's unloved and not at all, in vogue. So I do think there's a trade there, but not because the dollar is going to collapse, but because I think that's a trend right now. I think the trend has legs. So will there be corrections? Yeah, obviously we hit 2000. We had $2008 on Friday, something like that. We're off a bit today to 1950 or 1940. There'll be corrections along the way for sure, but I think there's an uptrend right now in the price of gold. Major reason why I founded Monetary Metals and why our focus is on interest rather than on price is that it should be an axiom of economics that whole generations, whole societies can't get rich by betting on asset prices. It's just a zero-sum game, right? One guy's gain is somebody else's loss somewhere. But interest is the thing that literally pulled the world out of the dark ages and allowed the rebuilding of civilization, because it's the perfect win-win deal. On the one hand, you have somebody who has wealth but not income. Right? If you have a kilo of gold, you have a significant amount of wealth, let alone if you have people that have hundreds of kilos of it, right? That's a significant amount of wealth, but it generates no income. On the other side of the trade, you have an entrepreneur who's full of energy and ideas, but doesn't have any wealth. He has the ability to generate income. And so I love how I studied under a guy named Fekete, Hungarian. I love how he defines a loan as an exchange of wealth and income, a win-win deal between the saver, who's usually older, who has the wealth but not the energy and not the income at that stage of his life, and the entrepreneur is typically young, who's full of energy, but doesn't have the capital. And by financing something productive, it's win-win. It's actually win-win-win-win-win. The saver gets some interest on his savings, so he's not consuming the savings in retirement. If there's no interest, think about it. You're forced to hoard whatever the monetary good is, whether it's silver, salt, gold, during your working, career. And then when you reach senescence and you can't work anymore, then you're selling little bits in order to pay for groceries. What if you run out? That's the biggest fear, especially in those days. Nobody wants to be that beggar on the church steps who's run out of money at age 75 or whatever. But, they've run out of money, but not life. And so now, what do you do when you become a beggar? If you're earning interest, then you don't have that issue. At the same time, so the entrepreneur is able to make his product and get rich. The saver is able to get interest on his savings, and everyone else benefits because there's a new product, or at least a greater quantity and therefore lower price of whatever product the entrepreneur is producing. So society gets a net win. And so that's why I founded Monetary Metals, was to re-enable that the central banks, in collusion with the commercial banks, have basically destroyed, they've waged a war on interest, and they've basically won. And now with this, as I explained earlier, abortive attempt to hike rates, which is going to fail. And even so, your savings account doesn't pay meaningful amounts of interest. The average savings account in the United States as of, I think, Friday, 0.37% interest, something like that. For a variety of reasons, the interest rate doesn't go up available to the savers. So they've killed interest. Unlike the war on drugs, the war on poverty, the war on all these other things, they actually did win the war on interest. And so you can't really be a saver anymore. They've kind of destroyed that. And so we think that it's not so much a trade as buy this thing, let it go up, and then what? Force it off on somebody else who's going to give you more of his hard-earned capital than you gave to the previous guy in your speculation. Instead, put it to work, in an investment sense, put it to work and get a return on it. And it's not get rich quick, right? If you buy the right asset, and I don't know if Bitcoin's going to go from 27,000 to 37,000, but if it did, and you put $1 million into Bitcoin, well, you just made a huge amount, in 3 days. Earning 2 or 3 or 4% interest on your gold isn't going to be like that. It's not get rich quick. And it may be out of vogue in certain demographics, but it's what makes the economy go round. It's what got us out of the last dark age. And if this isn't rediscovered, we're going to get into the next dark age as a result.
You did mention, though, that eventually interest rates have to fall and debt has to grow. QE of sorts have to come back into the markets. That would, though, be beneficial for the gold stocks. So the gold miners, the gold explorers, the gold developers. So there is a way to sort of speculate on gold as well, right?
The gold miners are a very interesting sort of case study of how the Fed cycle impacts different industries. And we published a guest post by Morgan Poliquin. We don't publish very many guest posts on our site, but we published this one, and he was talking about how the gold miners have basically underperformed gold on the way up and underperformed on the way down for a very long period of time. And he was talking about how the Fed cycle really impacts the gold miners. I mean, in a certain sense, in the first instance, I agree with your comment. Right now, the gold miners find it almost impossible to raise. There's no money for gold miners today.
Yeah, sure. Yeah.
I mean, so when interest rates go back to zero and beyond, that will probably free up some capital to the gold mining sector. but they're kind of the last at the long end of, at the end of a long table where everyone is passing the, whatever potatoes and everyone's taking a scoop. And by the time it gets to the last guy in the end, there's one or two scrapes left on the corner of the pan. That's about it. They certainly don't get first access to capital. If there's an analogy to the Cantillon effect there at the end. But beyond that, in a certain sense, it'll be good in a certain sense for everybody in that credit will begin flowing again when they push interest rates back to where they were and beyond. And so everyone will feel things are easier, investments are going up, jobs will become easier to get again, and so on. But in a certain sense, it's just the continued grinding forward of this sausage machine, the sausage grinder that's grinding up people and ultimately the economy and spitting it out as mincemeat. Is there going to be a good trade in gold mines? Yeah, almost certainly there would be. But you got to get the timing of that right. I mean, how long until the Fed or the ECB or whoever blinks and says, okay, we're going to officially lower interest rates? And you're saying earlier about crystal balls. There's certain predictions I feel I can make because it's monetary science and say the interest rate has to keep falling. It's not a matter of opinion. It's not a matter of what anybody might want or what should happen to make the economy go better. You can just look at it and say, this is how the system is wired. But when it comes to when is a politician and the heads of these central banks, they're politicians fundamentally, even if they have a PhD in economics, they're acting as politicians. When is a politician gonna, reverse their opinion, reverse course? How do you predict such a thing? I don't have any special insight into that. And the politics get very weird. In the US, when Trump said he was going to cut taxes, they decided that they were going to not allow anymore. So before that point, if you paid state and local taxes, that was deductible on your federal taxes. Out of a sort of a principle of fairness, you've already paid tax on that money. To pay it again, was just unfair. But they decided, even though they said they were cutting taxes, they decided to end that deduction. And now you have to pay federal taxes even on whatever you lost to state and local taxes. And the reason was it was a very, very weird political situation that the Trump right thought that this is going to primarily hurt rich voters who vote for the left, that vote for the Democrats. And so they thought that this was a targeted, sort of a get vengeance against the liberals by not making state and local taxes deductible. That was going to get rich liberals in blue states. And now, whether or not that's true, that was the perception. And so you get some very funny politics. And I could see how the politics could line up in favor of more QE versus not more QE along very funny lines. When you look at the bailout for Silicon Valley Bank depositors, the extreme right and the extreme left both hate it. The extreme right thinks it's a bailout to the woke left in Silicon Valley. The extreme left thinks that it's a bailout for rich white boys. And so the extreme left and the extreme right could be marching arm in arm. The swastika with the hammer and sickle marching arm in arm on that particular issue, at least. On all other issues, they want to kill each other. But on that issue, you could see some weird things. So how is the Fed going to behave? Very opaque to me.
It's true. It's true. I was thinking about the swastika and the sickle because they did march together for a while. But the point that you're making there is also interesting to me as someone who is interested in higher risk assets, like the explorers specifically, because if you have to wait for interest rates to for QE to come back into the markets, for interest rates to start falling, you're exposed to severe dilution risk with most of those. So I was thinking if you have, because I know that you do look into some of them, although not you don't necessarily comment publicly on individual names, and I don't need you to do that. But How do you look at them as a whole, and the dilution risk and the weighting risk, and how do you approach exploration companies as a whole?
So we are, I mean, professionally, we're lenders. So we focus on the other end of the space, which is companies that are either in production or with our loan will be in production. So on the explorer end, we meet those companies all the time, but we don't do business. They're not ready to do business with us. The challenge is, right, so I just came back from the Minds and Money show in Miami, I guess a few weeks back now. The story is the same there versus the Swiss Mining Institute in Zurich versus a lot of the others. You see these companies that have 1 million, 2 million, 3 million ounces of resource in whatever category. And the market cap is like $10 million. And sometimes that's like 10 million Australian or 10 million Canadian dollars, which makes it even worse. And the market is either saying one of three things. Either we don't believe your resource. I'm not sure obviously there are liars in the business, but I'm not sure that's necessarily the case. Or the market's saying, sure, but you're going to dilute the you-know-what out of me by the time you get between here and there, and you're actually producing the first of that million ounces. My share is going to be a tiny fraction of what it is now. Or you don't have any credibility you'll ever be able to raise the money to get there. Dilution or no dilution, you and what army are going to raise the 100 million you're going to need to get into production with that. And so, there's an extreme skepticism there. And so if I was the CEO of one of those companies, my every waking moment would be on how do I have credibility to either get to an exit with, sell it to a major, or to get into production without just diluting the crap out of my shareholders. And then, communicating the story. That's what I would be doing if I were them. If I was an investor, I'd be looking for the ones that had real credibility to get to at least enough production to be able to pay for further exploration out of revenues, rather than by just constantly going back to the shares market.
Mm-hmm. So it is sort of on the too risky to dabble in scale. Is that for the current?
No, what I'm trying to say is whenever a sector is perceived as too risky, what you have to do is become smart and drill down and find that there are better ones and worse ones, and the better ones are tarred with the same brush. Find the ones that have a real credible path to get to production or get to a sale to a major, and focus. Put your bets on those companies rather than just the sector broadly, because a lot of those companies never will. The share prices are too low. There's too much dilution to really do anything. So the eco long, and they're sort of dinking around, drilling a hole or two now and then, but they don't really have the capital to realize their business plan. And if you just come in and give them a little bit of money, it's not enough. It never is. So you've got to differentiate. You have to be highly selective. That would be my observation and my 2 cents. And I'm not a professional stock picker in this space by any means. So take everything I say with 2 fiat pennies. That's what's worth.
It's also that the company you give your very little money as a retail investor might also end up buying new suits or a private jet ride for the CEO to get to some fancy conference in a nice party. So it's also something that I'm always on the lookout for. But
that's right.
Yeah,
you want to see people that are respectful of their investors' capital and not living large on investors' money. The revenues are there and the company's profitable. It's a different story. But if they're living on investor money, you want to see people that are flying cheap and being efficient stewards of the money. Absolutely.
And like no 5-digit suits. That's just out of this. There's no reason for people to have 5-digit suits, right? Like there's not one. I mean, I understand you got to make a good impression or something, but like you can buy an expensive suit for $1,000. It's expensive enough. We've been talking for almost about.
I can give advice on that because I've done this personally.
Go ahead.
There are tailors, especially based out of places like India and Hong Kong, that for $1,000 you can get something that's custom. Now, it may not be the most highest of high-end fabric with only virgin alpacas and whatever, but it'll be something that fits you like a glove. That's what really makes the suit look good.
Yeah.
It'll be good material. It's not going to be crap material. It's not going to be polyester with that plastic shine to it. But the fact that it's tailored means it fits. If it fits, it looks good. And that's what anybody, investor or mining CEO, should be doing, in my opinion.
Definitely, if they're visiting some of these places for conferences. Good point. Yeah, good point. There's no reason to buy a branded suit like Armani or Boss or whatever it might be. So, good points. We should make a clothing podcast. We've been talking for about an hour and a half, so I assume I've annoyed you enough already with my questions. I wrote down sort of a 5-point summary. It's not a 5-point summary, but I noted the 5 most important things that stood out the most to me. Is it okay if I go through them and you tell me if I'm what I missed and what you would like to add?
Absolutely.
Okay. So we started off very strongly, actually, in the first minute. You said that we are falling in the black hole of zero interest rates, which is not good because interest rates equal prosperity, more or less. That's sort of the point that I tied together there. Is that correct?
Not interest rates equals prosperity, but prosperity has some requirements. And one of those requirements is a stable interest rate. If the interest rate is unstable, then that is going to undermine prosperity, whether rates are rising or rates are falling. Either way, that's undermine prosperity.
Right. And then sort of also related to that, you told me that you can pretty much foresee 2 things happening, not because you have a crystal ball, but because it's monetary science, and that was interest rates have to fall and debt has to grow. So they have to go back to QE of sorts. That was the second point. Is that right?
Yes.
Okay.
The debt has to grow exponentially. It's not just a little bit of growth. It has to grow proportional. So the new amount of debt added has to be proportional to the old amount. And a rough way of thinking of that is it has to be at least the accrued interest. Remember, not everybody's paying the Treasury rate or the ECB rate. The marginal borrower was already paying 5 or 6% above that even before interest rate hikes. There has to be enough extra cash floating around that even the marginal borrower can make enough revenues to service their debts. So that's a pretty significant growth in quantity of dollars in order to keep that going
exponentially. He also said that that's sort of the third point as well, that eventually the dollar will fall. Eventually it's going to die off. That's how these things happen, but we're not there yet. So you say no to the de-dollarization narrative, and you also say that when it comes down, when the dollar's going to die, you say it's not months, it's years, could potentially even be decades. That's the third point.
Yes.
Okay. Because of that, we talked about buying some gold. You said buy some gold to keep in your sock drawer, but not a lot. And buy it sort of in divisible amounts, so that you don't buy like, I don't know if that even exists, but like a block of 10 kilos of gold or something like that. And then you say have the rest stored professionally. I thought that was a good point as well. So.
Yeah, absolutely.
Okay. And then the fifth point was that, again, about gold. You said that gold is in a bull market, but it's a long-term bull market. So it's going to take time. It's not a get rich quick thing. And that the current environment is not too promising for the miners, which is true. Most of them have been reporting losses recently. So that was sort of the last point that I wrote.
Yep.
Okay. Well, if you agree, I'm happy with that. I thought it was a good call. What else am I missing? What else would you add here at the end?
Can't really think of anything. You can follow me on Twitter at RealKeithWeiner, and my website is monetary-metals.com.
Okay, good stuff. Well, thank you for that, and thanks a lot for investing your time in me, Keith.
Thanks for having me.